Hello, welcome to this month's Any Answers Answered for Accounting Web. A couple of questions Tim and I have picked from the Any Answers pages. The first question I want to have a look at, Tim, is quite complicated actually. It's from a guy called Carl Munns, and the question relates to non-resident UK tax as far as New Zealand is concerned. We're not going to get too bogged down in the New Zealand double tax treaty, but let's have a look at the question. A shareholder of a UK company has asked me if he has any liability for the additional 7.5% dividend tax. Carl's response was no. He needs to put it on his national insurance. He needs to put it on his New Zealand tax return. Is that everything? But actually, no. The point is that that tax will be due potentially on the UK dividend tax. It's not the old 10% credit system anymore, but the implications for non-residents is quite complicated.
Well, as is so often the case with tax, when you look beneath the surface, all sorts of interesting angles crop up. We know that from April 16, the tax rules for dividends in the UK changed significantly, and mostly the shareholder is eligible for the dividend tax allowance, the first 5,000 at 0%, and then if the dividend in excess of that is within basic rate band, it's at 7.5%, the rate mentioned here, the ordinary rate for dividends. But if it's within higher rate, then 32.5%, top rate 38.1%. Without any tax credit, dividends are no longer paid net, there's no grossing up of a notional tax credit. On top of that, there's a long-standing treatment for non-UK residents, which is that the tax on the UK dividend is limited to the tax, if any, deducted at source. Now, if my sister, who lives in Portugal and has lived there for 20 odd years, if she receives a dividend from a UK company, I can pretty well say to her, don't worry, you've got no tax to pay on that. In the UK, what happens in Portugal is entirely different. And that's because, as I say, the tax is limited to the tax, if any, deducted at source. But this question goes a little bit beyond that. The recipient is a non-UK resident, but in receipt of UK dividends, and therefore with that UK income, they do indeed have to consider the UK tax position, filing a UK self-assessment return. The dividends in question do not enjoy the 5,000 at 0%. So the first point is that non-UK residents, like my sister, like this New Zealand taxpayer, do not get the dividend tax allowance. And it's analogous, if you like, to trustees and deceased estates. That 5,000 at 0 is only available to UK resident individual shareholders. The second point is that we continue to enjoy that limitation on the tax on the UK dividend, the non-resident limited to the tax, if any, deducted at source. Now here there is no tax deducted at source, and therefore there is no tax as far as the UK is concerned on that UK dividend. But the complication arises where you've then got other UK income. And in this particular example, he has rental income from a UK property. Porsche 911, whose name I chuckle there because having read Porsche 911's commentaries, which are very helpful in Accounting Web for many years now, I've only recently realised that it's related to a type of motor car. But anyway, Porsche 911 gives an example where you've got, say, £50,000 of net rental profit on UK properties plus 8,000 of UK dividends, and that's for the New Zealand resident. And in that case, you do two calculations, one of them with the benefit of the UK personal allowance, and in that one we don't limit the tax on the dividends to the tax deducted at source, which would be 0. We bring them in, but without the benefit of the 5,000 at 0%, but they do get, as another commentator under the name Ruddles pointed out, a tax credit of 7.5%. The ordinary rate is given as a tax credit on the net dividend in the UK tax computation. That's under section 399 of ITOIA 2005. And then we do an alternative calculation without the personal allowance and limiting it and seeing which of those gives the lower figure. Now, that's all in the UK. What happens in New Zealand will be down to them and very different. But what this thread demonstrates is the complexity of the tax rules where you've got a client who's got UK source income, including dividends as here, but is non-UK resident.
So let's just make sure we're happy with exactly what we're saying here. The first thing to pick up on is that an individual who is non-resident in the UK does not qualify for the £5,000 at 0% tax. But then the calculation that you perform is to find the lower of two options. And just go through those two options again for us. The first is to do the calculation as if they were in the UK, I think. Is that correct?
With the benefit of a personal allowance for a UK citizen, because this is what we used to call the British subject resident abroad. So with the benefit of the personal allowance, but bringing the dividend in and taxing it at the appropriate rate, 7.5, 32.5, 38.1, without the benefit of the 5,000 at zero.
Okay.
But there you're taking the personal allowance against, in this example, the rental profit.
Okay.
But then you do the second calculation, which does not include the personal allowance, but which limits the tax on the dividend to zero, effectively. And we look at which of those gives the lower, and that would be the UK tax liability for the non-UK resident individual.
Okay, before they then go off and look at the double tax agreements and deal with whatever New Zealand are demanding of them.
Exactly.
The point is, it is considerably more complicated than the old system was, which was the 10% was basically all you had to pay and it wasn't payable anyway. And also this £5,000 rule, which a lot of people have
That's
missed.
the additional complication.
Yeah, okay. Second question this month is to do with principal private residence relief and also furnished holiday letting. It comes from an individual whose name is Tax Perfect on the website. And very simple question. Client buys a property in April 2010 for £100,000 as his PPR, lives there for 2 months, not a desperately long period of time, lives there for 2 months, then it's used as furnished holiday letting, and this person is entirely satisfied, all the criteria are met, before selling it 6 years later for £250,000. So let's make the numbers simple. We have 2 months where they live there. We then have very nearly 6 years, just under 6 years, where it's FHL, a gain of £150,000. But do they get PPR?
Well, the first issue here, which comes out in the thread when Michael Blake, I've known Michael for years actually, quite a well-known tax consultant, points out that the agent advising this particular taxpayer should start by questioning the circumstances of the occupation as private residence, because there's an increasing number of cases where the tribunal agree with HMRC that in circumstances where the taxpayer occupied the property as a residence for a remarkably short period of time, as you say, it was just 2 months here, they're going to have to go some to persuade the tribunal that they established the quality of occupation that would be necessary for it to count as their exempt residence. But leaving that aside, so let's take at face value that they did establish that it was an exempt residence, albeit for that first 2 months. We then move on to the question of how do you calculate the exempt gain under the main residence exemption rules, and how then do we treat the balance of the gain given that the property was used under the furnished holiday letting regime, which does then qualify the gain for entrepreneurs relief.
Okay, so of the 6 years that we're looking at, we're going to say the first 2 months are going to qualify for PPR, and presumably also then the last 18 months will qualify.
Yeah.
And then on top of that, the property is let. I mean, it's FHL. Do we still get letting relief?
We do, and that's one of the first questions that comes up in the thread. And one of the commentators, well, in fact, no, Tax Perfect himself, who raised the question, expresses surprise at the advice from Ruddles, again, that even though it's an FHL, it does qualify for the letting relief if it had previously qualified as a main residence. So, and he's right, Rolls is right, the answer is that it doesn't matter whether it's furnished holiday letting or any other type of letting relief under the main residence rules will be available. So we take the first 2 months in this case, the last 18 months, that proportion of the gain, 20 months worth, plus the amount under the letting relief rules would be exempt.
Okay, so another 40,000 comes off for the letting relief
Potentially, depends on the total
as
gain
well.
and the fraction, yeah.
And then the gain we have left will then be taxed, well, it's residential property, so we're looking at 18% or 28%, are we?
Well, if entrepreneurs relief applies, it's just 10%, and that's the point, because the gain that remains can be attributable entirely to the furnished holiday letting use, and that gain does qualify for entrepreneurs relief, and therefore would be taxed at just 10%. But if it didn't qualify for entrepreneurs relief, then today, because it's a residential property, it would be taxed at 28% rather than assuming higher rate taxpayer rather than at 20%.
Okay, and the entrepreneurs relief point is important, I think. The furnished holiday letting is what brings it into the entrepreneurs relief world. Had it been standard letting, of course, it wouldn't have qualified for entrepreneurs relief. Just add one more fly to the ointment. What if half the time it had been let and half the time it had been FHL?
Well, quite an interesting point was made, again by Ruddles, which is that the calculation of the gain that is attributable to entrepreneurs relief could be done on a just and reasonable basis, and that might mean that the revenue would restrict the amount that's available for the main residence exemption. However, Nina Porsche 11, or Porsche Nina 11, then pointed out that the just and reasonable approach is not applicable to the main residence calculation, where we take a strict time calculation to determine the 2 months, the 18 months, the letting period. And so, in her view, and I agree with her, it would be the balance of the gain that qualifies for entrepreneurs relief.
Yeah, so you would take the PPR first, that leaves you with a new gain figure to deal with, and that's the point at which we have to decide how much will or won't qualify for entrepreneurs relief.
Ruddles then came back, and this is the sort of thing that makes these Any Answers threads very interesting, with another point, which was that what if an individual owned a residential property but it was used in their business, perhaps their family company. They owned it personally, it was used by the family company, and they rented it to the family company, so there was letting of that property. And then there's a disposal of that residential property. And this was where he'd half remembered the just and reasonable approach, because the question then arises as to whether the disposal of the property gives rise to a gain that qualifies for entrepreneurs relief under the associated disposal rules. And for it to do so, there would have to be a material disposal, sale of the company shares, cessation of the company business, etc., for the gain on the property then to be an associated disposal. And in that case, the amount of the gain eligible for entrepreneurs relief is restricted by a just and reasonable approach by reference to the period of letting and the amount of rent that was paid by the company by comparison to the market rental. So,
absolutely, because we would have to have the minimal rent charge in order to get into the associated disposal rules.
Exactly, but it's a good example of how little bits of tax in one area make you think, oh, that applies here, and but it doesn't. One rule for something, one rule for something else, and that's what keeps us on our toes.
I was once told by a very good accountant many years ago that the most important thing to have for all clients is a diary, which just tracks what they're doing, what the property is being used for, things like that, throughout the period of ownership. Because, as you say, in a relatively simple situation, you could have a whole range of different tax treatments based on what it was used for at certain times. Just goes to show the complexity that we can end up with in what's a relatively straightforward transaction, actually, but because of the different types of use and all that sort of thing, can become almost unmanageable. Do keep posting your questions on Any Answers, and perhaps next month, Tim and I will discuss your questions and hopefully give you the answer that you're looking for. But for this month, bye-bye.